Hi everyone, how's it going? My name is Kalle and I talk about luxury and finances. So I am a stock investor, more specifically a dividend investor. I mainly invest in stocks for the passive income they generate into my bank account in the form of dividends. In today's video, we're going to deal with a pertinent question a friend of mine once asked me. What if my stocks go down or fall in value, plummet, crash, tank, however you want to express it? We will cover 3 points. First, dips will happen, but they're not something for you to worry about as an investor building wealth. Second, diversification will shield you against losses in the long run. And third, dividends will roll in. So, first of all, when you invest in stocks, you're bound to face a dip at some point. It can be a general crash, as we saw with the virus shock in March 2020, or then it can be a less comprehensive phenomenon affecting an individual company, a certain industry, or a certain geographic zone. Dips are a natural part of the economy, but on the other hand, as the saying goes, the markets also always go up and end up beating previous record levels. Now, investing is a long-term project, I would say minimum 5 years, in which you build wealth. Investing is not speculation about the stock price. Since you are in the project for a long period of time, short-term or even longer turbulence, which is bound to happen, basically means nothing to you, although granted it can be psychologically stressing. However, with the emotional strain that a downturn could cause, you should never panic sell your stocks, because that's where you'll make losses, plus lose all the future dividends. Eventually, the stocks and the markets will bounce back, as we saw with the financial crisis of 2008, 2009, as well as with the coronavirus dip. Instead of selling, you should keep buying, because you will get stocks at a discount. Moving on to the second point. Now, the rule number 1 in investing is diversification, which basically comes in 3 forms: cost averaging or diversification in time, industry-wise diversification, and geographic diversification. To cost average your share purchases in practice means buying with the same amount of money every month. When you do this, you will get more shares when the markets are low, and conversely, fewer shares when the markets are high. In the long run, cost averaging has widely been demonstrated to be the most lucrative method in building wealth, as no one can time the markets. When you cost average, a downturn is just good news for you, because you will get stocks at a discount, as we just mentioned. People will buy clothes on sale, so why wouldn't they buy stocks on sale, something that builds them wealth? Just as with clothes or any goods, the higher normal prices will eventually bounce back. If someone says that they lost money, for example, in the financial crisis of 2008, it's because they sold and they didn't practice cost averaging. Had they continued to buy all through the debacle, they would be very wealthy. On a side note, when it comes to the S&P 500, the 500 biggest listed companies of the United States, even if you didn't cost average and bought the S&P 500 index with a lump sum at any point in history and left your money in the index for 15 years, your money would have grown. That being said, back to cost averaging. In addition to cost averaging, you have to follow the rules of diversifying industry-wise and geographically. So you want different industries and stocks, not just in your own country. Now, you can obviously build a stock portfolio with diversified individual stocks or companies, but the simplest way to diversify is to buy a mutual fund or an ETF, such as an S&P 500 ETF. As a rule of thumb, ETFs beat mutual funds because the expenses of ETFs are minimal. So you buy an ETF at the stock exchange like you would buy an individual stock. Let's move on to the third reason why dips are not something to fret over. There is a saying, dividend comes first. Since I am a dividend investor myself, I don't invest in stocks with a price in mind, hoping to sell later at a profit. Basically, I just buy and hold, I'm a holder, and let the dividends roll in. I invest for the passive income that dividends pay into my bank account. Granted, some companies may slash their dividend or even stop paying it when there is turbulence. However, if you're properly diversified, you have always received your dividends in history. And talk about the dividend aristocrats, which have raised their dividend for at least 25 consecutive years, even through the financial crisis or the virus dip last year. And then there are the dividend kings with at least 50 years of increasing dividends. So when it comes to dividend kings, I own, for example, Coca-Cola, Procter & Gamble, 3M, and Johnson & Johnson. Besides, many of these blue chip, well-established companies make products that people need and use every day, no matter what the economy is. So when there is a general dip, you will get these quality companies at a discount and hence increase your dividend flow. And as far as these dividend aristocrats and kings go, you could buy all of them as an ETF. I own a couple of different dividend aristocrats ETFs. Both of them have increased in value over the years, but the capital appreciation is not the point. Instead, they pay a reliable dividend. So, in a nutshell, your stocks will go down at some point, but since you are an investor building wealth and financial security in the long run, the dive is not meaningful and does not equal losses. On the contrary, you will benefit from the dive with cost averaging or diversification in time. In addition, diversifying geographically and with different industries are fundamental principles of investing. There you have it. Investing does involve risk, but that risk can be managed, and if you don't invest, you're bound to lose money. I will finish with a quote from Martin Paasi, a Finnish financial expert. So he has said, "There is risk in investing, but it is equally certain that stock investing will build you wealth in the long run." Thank you so much for watching. I really appreciate it. Please comment, like, and subscribe, and I'll see you guys in the next video with financial and/or luxury content. Bye bye.